Today, we are going to talk about our learnings from past market corrections and how investors should think about them. If you look at last 15 years, there have been 6 instances when index corrected by at least 15%, including the last correction that started in October 21. If you look at the data, a few things come out. Firstly, it's almost impossible to predict when the market correction would start and when it would end. Also, each correction is different from others in terms of extent, duration, and causal factors. But there are 2 things which are common across all corrections. Firstly, the market returns post-correction tend to be very good. In fact, if you look at last 5 corrections, the average returns from the bottom is in excess of 50%, 3 times the average returns from the markets. And secondly, and interestingly, there is a leadership change sectorally before the correction and after the correction, which means the sectors that tend to do well before correction are very different from sectors that tend to do well after correction. So what does it mean for investors? First, because market corrections are part of the equity game, do not get perturbed. Second, because it's impossible to predict when the correction would end and the returns post correction tend to be very healthy, it makes sense to continue with your SIP to increase allocation during the correction phase. And thirdly, instead of fretting about when the correction would end, it's much more profitable to focus on positioning your portfolio right so that you are in the right sectors when the correction ends. At Girik Capital, we focus our research attention on identifying the new leaders so that our investors benefit when the market bottoms out and starts to recover. Thank you.